Welcome to the Capital Breakdown. Today we're tackling a big question. Are your feelings about the market costing you more than the market itself? It's easy to think that stocks going up or down are the biggest threat to your money. But often, the real danger lies in how fear, greed, and FOMO, fear of missing out, drive our decisions. By the end of this episode, you'll understand how these emotions can quietly wreck portfolios, the science behind why they sneak in, and most importantly, how awareness and discipline can help you stay on track. So buckle up, because we're diving deep into the emotional roller coaster of investing. Most people think investing is just about picking winners or avoiding losers. But what trips us up more than the market's ups and downs? Our own feelings. Imagine you're at a buffet. When everyone rushes to the dessert table, you might grab too much sugar and forget your balanced meal. Similarly, in investing, fear might make you sell when prices dip, locking in losses. Greed can push you to chase the hottest stock or asset, ignoring risks. And FOMO? That nagging feeling that if you don't jump in right now, you'll miss out on big gains. These emotional reactions are natural, but often lead to buying high and selling low, the exact opposite of what builds wealth over time. Let's break down these emotions like ingredients in a recipe. Fear is like a warning light, signaling potential danger. It can protect you, but if it's too loud, it stops you from moving forward. Greed is the fuel that drives us to want more. More money, more gains, more excitement. But without a map, it can send us off course. FOMO is that voice whispering, "Everyone else is winning, why aren't you?" Think of your portfolio as a garden. Fear might make you pull out plants too early. Greed might push you to plant exotic seeds without care. And FOMO might rush you to buy whatever's trending, regardless of your garden's needs. Understanding these emotions is the first step to managing them. Behind the scenes, your emotions are influenced by how information and money flow through the market. Investors range from individuals to huge institutions, all reacting to news, data, and each other. Fund providers package investments into products like ETFs or mutual funds that make it easy to buy a slice of the market. Brokers facilitate trades, and regulators try to keep it fair. But this ecosystem is noisy and fast-moving, which can feed emotions. When prices rise sharply, headlines shout greed. When markets stumble, fear dominates the conversation. Your brain is wired to react to these signals, sometimes too quickly. Recognizing this can help you pause before making impulsive moves. Imagine two investors. The first invests a fixed amount every month into a broad market index fund, like a basket that holds many different companies. This approach smooths out highs and lows over time, kind of like filling a bucket gradually rather than dumping water all at once. The second investor chases a single stock that's been skyrocketing, buying more as prices climb, fueled by excitement and FOMO. When the stock plunges, panic sets in, prompting a quick exit at a loss. The first investor experiences fewer emotional swings and benefits from steady growth, while the second rides a wild roller coaster. This example shows how simple discipline can help keep emotions in check and portfolios more balanced. Where do investors usually get into trouble? One common pitfall is concentrating too much on a single stock or sector, hoping for big gains but risking big losses. Another is using leverage or margin, borrowing money to invest, which can amplify both profits and losses and lead to emotional stress. Short-term market volatility can also trigger knee-jerk reactions, like selling in a panic or chasing a hot trend. The key is patience and understanding that markets don't move in straight lines. Building a diversified portfolio, aligned with your time horizon and risk tolerance, helps shield you from emotional impulses and unexpected shocks. It's important to remember that investing isn't just about chasing returns, it's part of a bigger financial picture. That means having a budget, an emergency fund to cover unexpected expenses, and clear goals like retirement or buying a home. When your financial foundation is solid, it's easier to stay calm during market swings and avoid emotional decisions. Think of your portfolio like a long-distance road trip. You don't speed recklessly because you want to arrive safely and enjoy the journey. Similarly, steady planning and realistic expectations help you navigate the ups and downs without losing your way. So how can you manage these powerful emotions? First, awareness is key. Recognize when fear, greed, or FOMO start influencing your thoughts. Next, create a written plan that outlines your goals, risk tolerance, and investment strategy. Having this roadmap helps you stay focused when emotions rise. Also, consider automating investments to remove the temptation to time the market. Finally, don't hesitate to seek guidance from qualified professionals who can offer objective perspectives. Remember, no strategy eliminates risk entirely, but disciplined approaches help keep emotions from steering your financial future off course. Let's circle back to why this matters. Emotional investing often leads to buying high and selling low, the opposite of what grows wealth. Markets naturally fluctuate, and trying to predict every move invites stress and mistakes. By understanding the roles of fear, greed, and FOMO, you can build habits to resist impulsive decisions. Think of your emotions as passengers in a car. You're the driver. You can acknowledge their voices, but choose the direction. The Capital Breakdown is here to help you tune into these signals without letting them control you, turning emotional investing into informed, confident decision-making. Before we wrap up, keep in mind that investing involves risks, especially with single stocks, leverage, or speculative strategies. Diversification, patience, and a clear plan are your best defenses. Markets don't reward guesses or shortcuts. They reward consistency and discipline over time. Always do your own research and consider talking to a qualified financial professional who understands your unique situation. The goal is not to eliminate emotions, they're part of being human, but to manage them so they don't derail your financial journey. To recap, 1. Fear, greed, and FOMO are powerful emotions that can quietly sabotage your portfolio if left unchecked. 2. Understanding these feelings and how markets work helps you build a disciplined, patient approach. 3. Integrating investing into your broader financial life, budgeting, emergency savings, and clear goals creates stability that keeps emotions in balance. This episode is purely educational to empower you with knowledge, not specific advice. Always do your own homework and consult professionals when needed. Thanks for tuning into the Capital Breakdown, where we break down the complex world of money into clear, confident steps you can take today. Stay curious, stay patient, and keep building your financial future with calm and clarity. See you next time. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.